Welcome back. Company Chief Executive of Eqstra, a 3 billion rand company listed on the Johannesburg Stock Exchange. Walter Hill is with us to unpack results for the financial year to end June. The bottom line looks really strong, Walter. The 35% growth in headline earnings. I suppose the number we really need to focus on here at this point in our lives is dividend up 28%. So cash is good. You guys are in a good place.
Yes, I think it's been a tough year. The economy is not doing well. But Eqstra is showing its resilience and its robust business model. And we're very happy to have been able to declare a dividend at 36 cents a share. And 1.04 rand headline earnings is satisfying for the group.
Let's step away a little. It's a business that buys capital equipment, primarily for the mining industry, and then leases it out.
Yes, about 30% of it is for the mining industry. The rest is for other industries and fast-moving goods. So we've got quite a wide diversification. Unfortunately, the mining industry is our biggest, but it's only the SA mining is 30% of our business, and it does attract a lot of attention because the labour exposure. It's the one area we do have exposure to the labour climate. We have no retail exposure directly. We do B2B business with a lot of the blue chip corporates in South Africa.
I'm trying to unpack that and get an understanding of whether the strikes and the strike season that we're going into is good or bad for you. We've seen in South Africa that the capital to labour ratio has been moving in your direction for years, for decades perhaps, because of labour issues here. Is it still going in that way?
I think labour is bad for South Africa strikes. It's not going to get away that it impacts anybody. I think it'll affect all industries in South Africa. If you're not going to be impacted directly, you will have an indirect impact. So the current labour climate does not do good for any corporates. I think there's a lot of issues that we have to deal with. From Eqstra's point of view, we've been very active. We've gone through this financial year. We've been very lucky. We've had no material industrial action. One of the benefits is we are considered to be labour light, capital intensive. But we cannot think we're going to escape the labour situation currently. It will move from sector to sector, and I've got no doubt whether it's impact on ourselves directly or on our customers giving us an indirect impact, all South African industries are touched by the labour situation.
Well, let me rework that question then. If the capital to labour ratio continues in the direction that it's been going, in other words, companies are spending more on capital equipment and less on labour if they can, surely that would benefit a business like yours.
It does. You know, the Western Cape farm strikes that occurred down in the Western Cape benefited us. A lot of the farmers were labour intense. They used a lot of manual labour. They moved to mechanisation. They have converted to forklifts. They've converted to automated loading equipment, and that is what we lease to the sector. So yes, I think the mechanisation is inevitable, and that definitely does benefit us in the long term.
Could you work out from these numbers, from this good set of numbers that you put on the table, how much of that is the trend away from labour towards mechanisation?
No, I think, as I said, all our activity is mechanisation in some way or other, particularly the mining side, and then the industrial equipment, the forklifts. Invariably, forklifts over time have displaced manual labour that used to be used for loading trucks and loading equipment and packing equipment. That has all been mechanised over the years. We've grown to that business to be 35% of the South African market share, and a lot of that has displaced, not competitors, it's actually displaced manual labour.
Walter, just on a couple of specific issues. When we spoke last, it was at the time that Barlow World was taking over the Bucharest contract. It was quite a big contract for them. You had it previously. You did say at the time it wasn't going to have a material impact on your numbers. Has that worked out so?
I think it has, my personal opinion, I think Bucharest had the original Bucharest. We had the TEDx mining component, which was bought by Bucharest and then on-sold to Caterpillar. I think it would have had a negative impact. We've seen commodities going down quite considerably. And I can't talk of the other part that of Bucharest that was bought by Barlow World, but certainly I think our part, we're not sad to have seen it gone. I think the bubble has burst the second time around on the commodities, and I do think that type of equipment is under pressure now. It might be underpinned the rest that Barlow World bought, but definitely the component that we had, I think it's a good business, but it's just a cyclical business which we wanted to get out of.
475 million is what you put into your cash towards the end of the last financial year. So you're pretty happy with that number
We're very
today.
happy with it. Today we're very happy with it. We're not regretting it, no.
What about Protect Kutelia? I'm still in the dark, and I think many other people are. What is going on there? You've got a stake in the company, or last reported at nearly 33%.
We're maintaining our stake. I think Protec, we just decided rather than go in, you know, if one wants to acquire a company, you need at least management on side. It was very clear they were arguing a price that was significantly beyond our appetite. The 60 cents a share was where we tested it, and we were quite happy with that. They were offering, saying to their shareholders, it's worth 78, 88 cents a share. We realized that they were going to fight us. I don't want to buy a company that management is not inside. You've got to remove management. We decided to let the offer lapse. We still believe it was a good offer. We still maintain our share of 32%. And the challenge is now for management to deliver the 78, 88 cents a share. We have held onto our shareholding. And it's settled down. I think it's reached a high of 52 cents a share. So it's nowhere close to the 60 cents we offered shareholders. We believe that our offer was good.
So it's sterilized. That 32 odd % that you hold in Protec could tell you you're not doing anything more about it. And
at this stage, we're not doing anything, and we've let the deal lapse.
And they are not interested in engaging with you in any way.
Oh, we'll talk. I think we are a shareholder. We have definitely we could engage, but I think we want to see that share now perform and give us 78, 88 cents as promised to shareholders. So I think the challenge is on for them to deliver.
And overall in your business, though, the key determinant is interest rates. You've got a lot of debt on the balance sheet. Interest rates have been, again, very much in your favor, very low, historical low around the world. Is there can you define to us, if there were to be a 1 percentage point increase in interest rates, what that would do to your bottom line?
Negligible. One must understand, Eqstra, we're not just a high debt business. We are correctly geared. Every rand of debt that we gear, we have an asset that has the matching maturity as what that debt has, and invariably it has the matching currency. So we don't take term risk. So we don't take on assets on a lease if we don't have underlying debt matching it. Also, we don't take a currency risk. So if it's a dollar-based lease, we get dollar-based funding. And also the interest rate. If the customer wants variable interest rate, we get variable interest rate to match it. So a lot of people are confused and they are concerned if interest rates move. We actually enjoy a high interest rate because we have got 3 billion of our shareholders' equity tied up, not in buildings and dealerships, but tied up in revenue earning assets. If the interest rate moves upwards 1%, that 3 billion gives us a return of 1% that moves upwards. Also, if it moves downwards, that moves with it. So we are hedged against the term of the debt and the currency. We don't take currency risk, and we also don't take interest rate risk.
So you're not actually interest rate agnostic, you're interest rate favorable if rates were to rise.
We are interest rate favorable if they go up. But
thanks for clarifying that issue and the Protec Kuteli issue as well. I think there are a few small shareholders who will be feeling a lot more, perhaps a lot more comfortable about Protec Kuteli, but they're not going to be getting a quick win on it. That was Walter Hill, the Chief Executive of Eqstra.